Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with the recent rally firmly on hold as the world awaits Israel's next move. Investors keeping one eye on US labour market data ahead of payrolls on Friday. Bianco of Bianco Research writing, "I'm still a no-lander," meaning I see the economy as okay, not even showing signs of a soft landing. I can debate whether we are seeing much cooling in this labour market. Jim joins us now for more. Jim, good morning and welcome to New York.
Thanks for having me.
Lisa went through the job openings. You look at what's happening with the quits rate. Quits rate's down. Look at what's happening with the hirings rate. Hirings rate's down. Why do you not see that as a sign of a slowdown in this labour market?
If you look at the bigger picture of the numbers, they are down from, say, July or June. But the bigger picture over the last several years, these are still numbers that are very constructive for the labor market right now. If you want to expand out from the JOLTS report to payrolls to the household survey, those numbers look pretty good. Now, the one number that is weak has been the rising unemployment rate. But the Fed likes to use the phrase increase in labor supply, which is a euphemism for migration. We're getting more people coming into the country. The population growth rate in the country right now, according to the CBO, is pushing a 30-year high because of migration. And a lot of those people coming into the country are unemployed, and that's what's getting picked up in the unemployment rate, which is why that number's rising. That's not necessarily a sign that people are losing jobs.
A 2-year at 360 doesn't scream no landing. 10-year at 376 doesn't scream no landing. What's your view on this bond market?
You know, I think that at 360 on the 2-year note, it is priced in pretty much the Fed cutting rates all the way to say 3 to 3 1/4. That's in. 2-year note shouldn't go anywhere else. Wall Street is really on this idea that we're going to see a curve steepening. I guess I am too. But at this point, that's a bearish trade because we're going to stay at 360, and the way you steepen the curve is the 10-year yield has to start to rise from here. I don't see the 2-year note going, say, under 3% unless you make the case the economy's really falling apart and the Fed is going to cut rates well beyond, say, 3%, down to around 2% or lower.
I love when people say I'm a no-lander, I'm a soft lander. It's sort of like saying I'm a flat earther, but there's sort of a question here about what that means. I mean, going forward, does that mean that there just is no recession, or does that mean that there actually is a reacceleration from here of growth and inflation?
You know, you brought up a really good point because I've criticized the soft landing camp, that it's a thing without a definition. So in a year, I'll define it and tell you I was correct. I think a no.
You do the same now.
Yeah. Well, I think a no-lander scenario is if you accept that potential GDP. What would the economy grow without it being stimulated or restrained is around 2.5%, 2 to 2.5%. I think that's the no landing camp, is that we continue to grow at the 2 to 2.5% camp. Also, if you wanted to throw inflation in there, I am in the sticky inflation camp that the long-run inflation rate is probably closer to a 3 handle, if not a 3 handle, then down at 2.0%, where the Fed thinks it's going to be. So if you add in the two together with nominal GDP, 2.5% real growth, 3-ish% inflation, you're talking about 5.5% nominal GDP, and that's where, the no landing idea comes.
How much does being a no-lander sort of hinge on this idea that authorities are ready, willing, and able to come in and step in, whether it's rate cuts, whether it's the bazooka we just got from China, whether it's potential fiscal stimulus in the United States, despite the deficit that people care about but aren't necessarily pricing in?
Oh, I think that, the no-lander camp, if I defined it the way I do, it's all of those things give me worried that we don't need the Fed to aggressively cut rates. We don't need massive fiscal stimulus. And if we're going to get it, what we're going to do is we're going to produce more inflation, and probably second half of 25. And that's really the biggest concern right now is, are we going to overstimulate? Because in the no landing camp, we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
You said you're going to take the over of the Friday's payroll report of 150K. Do you just immediately have to then slash 60, 70,000 off of that because of the revisions we continuously see?
Yeah, that's usually what happens. I think 25 of the last 31 months, the payroll report beats Wall Street's estimate. and then the revisions come in. And it's almost to the point now where people have been more and more asking me, what's your guess on revisions as opposed to what's your guess on the payroll report. Revisions, I think, are getting overstated a little bit, that usually when they run in cycles, the revisions. Up until 22, the revisions were mostly upward, and since 22, they've been mostly downward. And so I don't see the revisions as being some kind of dark secret thing that tells us that the economy's in trouble. But yeah, I probably see that the revisions will pull back on the numbers that we saw in July and August. But the headline number, like I said, most of the time it seems to be.
When we get the next payroll report, the following one, when you look at what happened in October, we're going to have Hurricane Helene's impact and also the strike workers at the ports. How difficult is it going to be to really extrapolate the labor data? Oh,
yeah, and don't forget the Boeing strike, too. And so I heard Mike McKee say this the other day, and there is a possibility of a negative payroll report coming up. The payroll survey week is the 13th. If these strikes keep going into disruptions into the 13th, and we find that, getting things back to normal after Hurricane Helene goes more than 2 weeks, we could see this start to impact jobs. Remember the way the jobs survey works. They have a company report. If the company doesn't have power or it's closed and it doesn't report, they put them down for 0 this month. They'll pick it up next month, revise it, and you could see a big dive in the numbers. Hurricane Harvey, we saw that last 2017 in September. We saw a negative payroll report off of that when it hit Houston.
Anna Wong of Bloomberg Economics, later this hour. Anna's put some numbers on this. If the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls due the 1st of November by as many as 80,000 jobs. They think that's going to lead the Federal Reserve to cut interest rates again by 50 basis points. If those numbers actually materialize, where are you on the Fed's move, November 7th?
That's going to be a difficult one, because if we were to see that type of number, and that's just off of the port strike, we still got the Boeing strike, we've still got the hurricane, and maybe disruption from the Middle East coming as well with energy prices. It's going to muddy the water for the Fed. It's going to make it very, very difficult to try and discern what is the economy doing. Yeah, we know that there's this port strike. Yeah, we know it depressed jobs. But we also know it's temporary, that the port strike will eventually end and things will eventually return back to normal. It's going to be very difficult for them. I think Powell set up the case for 25 at a couple of days ago when he spoke, in that seems to be more of the prudent action, especially that it's 2 days after the election, and there's a reasonable chance we won't know the outcome of the election by November 7th as well.
Jim, it's good to see you here in New York too. Thank you, sir. Jim Bianco there of Bianco Research.
Joe Davis, chief economist at Vanguard. Joe, thank you so much for being with us. I want to start just with weakening but not weak. How do you parse the difference at a time where we definitely are seeing weakening?
Well, sure, and again, I think that's also really at the heart of the Federal Reserve's response. So when we've clearly seen a slowdown in the labor market, part of that's been very welcome. I mean, we were out of balance for the past 2 years and had, really rapid wage growth. We're approaching the levels now where any further weakening or just slowing or cooling would really put, really bigger concerns on the table. I think the Federal Reserve has been weighing this information very importantly, and so, really explains some of their pretty aggressive moves. I mean, I think the big tension in the market is are the jobs figures really representative of the strength of the economy, or is it things such as GDP growth, which is going at 3% and not showing any signs of a slowdown?
So which is it, Joe? I mean, we just had Apollo's CEO Marc Rowan speaking with our own Jonathan Ferro, and he was basically saying that the 50 basis point rate cut was a really expensive insurance policy, and that actually this is not an economy that needs it based on GDP and based on earnings. What makes you think that the labor market data, like the underpinnings of JOLTS that show that quits rates have really gone down, what makes you think that we should more heavily weight that?
Well, again, I mean, I think the whole insurance phrasing is actually pretty appropriate. Again, the economy is pretty resilient. I think we still have some turbulence ahead. Our lead indicators, which you mentioned at the outset, still point to some further weakness, and they're pretty powerful indicators given just the breadth of our sample. And so I think what they're trying to do, again, let's be clear, the Federal Reserve is all in on the soft landing expectation, and so I think they're going to be fairly aggressive to try to increase the odds that that happens. gains, but there is risk in that strategy if the labor market, which I don't think it is, but if the labor market is sending the false signal and it's the GDP numbers that are more accurate or more representative, then 6 months from now we're going to have this crossroads, because the equity market, I think, is looking at GDP, and the bond market and the Treasury market is looking at jobs.
Well, Joe, Powell tried to solve this tension by just saying the labor market is a real-time indicator and GDP is not. GDP is historically bad at predicting a recession. Does that mean that we just can completely discount it, completely discount the strength and what it tells us about, one, inflation coming in and the likelihood that unemployment moves in a more malicious manner?
Yeah. I wouldn't be too quick to completely discount GDP, because underneath GDP is corporate earnings, corporate profits, business investment. And so I think it is important. I mean, again, I think, policymakers, to be fair to Chairman Powell, I think they are looking at a distillation, but there's no doubt that the Federal Reserve is weighing the jobs market much more heavily than the GDP numbers. Again, I think, the next several months will have some weakness. If we're right, then the Federal Reserve will look very prescient. But nevertheless, we're coming at a modest crossroads, I'd say roughly 6 months from now, and that is, and it's not a bearish crossroads, it's more of, is the equity market right and this softness in the labor market is going to stabilize and then we're following GDP, or is it going to be the latter and we're going to have GDP come from 3 to 2? I wish I had more conviction of which one it's going to be. Policymakers are trying to change that calculus in the next several months, but that is really the heart of the issue.
I love the way that you're phrasing this, because it's really accurate. It makes me feel like right now the labor market is going to dictate the bond market, and it's basically the GDP numbers. Atlanta Fed GDP is what almost every analyst who comes on the show who's bullish on equities points to and says, look, what slowed down? I just wonder how much the Fed could get ahead of this in economic terms. In other words, if they just cut by 50 basis points, if they do another 50 basis point cut, say, in November, how much could they affect change to actually bring the labor market up to GDP and GDI rather than bring GDP and GDI down to the weakness that we're seeing currently in the labor market?
Well, I think there are recent actions. There is some lag. So, I mean, the financial markets respond instantaneously. We're already trying to get ahead of the Federal Reserve. But in terms of the labor market, the next 3 months, they're pretty much baked. I actually wish I knew exactly what the numbers would be, but our leading indicators say, listen, there's still some choppiness, but they're not going to go negative. That would be a surprise to me. And so, again, I think where it's going to come out, the Federal Reserve is now trying to look 6 months out and saying, listen, we want to nail that landing. The only risk, I think, the more bullish part of the economists or analyst community is saying is, listen, you don't need to be cutting at all or not much. And so I think the Federal Reserve, if they're going to fight that narrative, they have to explain why they believe they're so restrictive and yet we have 3% GDP growth. I'm still waiting for the answer, but I think that's something that would be helpful for the Federal Reserve to articulate where they're going to go for the next 6 months.
Joe, but how are you going to review the non-farm payrolls report November 3rd that's looking back at October, when you see all these mismatches in the economy and people will be out of work? We know that because of what's going on with the number of strikes in Boeing and the ports.
Well, again, I think you have to look at other things. I think you have to look at the new entrants coming in. I mean, one of the biggest reasons why we didn't have a more material slowdown this year was just the surge in immigration. So you're going to look at a distillation picture. It's not so much what the headline is. It's the breadth of job creation. It's industries that are always strong. Are they continuing to add at a current pace? It's the hours being worked outside of those strikes and areas. So again, like anything in life, there's going to be noise in that report. I think what you're trying to say more than anything is the diffusion or the breadth of industries and companies that are continuing to add to just the jobs.
Joe, you also talk about something in your research, a phrase that feels like it's been dropped by the wayside as of late, and that is the last mile of inflation. That's some of the unevenness that you see. You expect inflation to remain stubborn in the second half of 2024. Does that mean this whole sort of idea that Powell was doing some sort of victory lap, even though he didn't explicitly say it, saying that inflation has been conquered, that's not exactly right?
Well, again, I think the Federal Reserve, they're one of the few institutions that can actually affect the outcome, because if everyone believes that inflation's under control, it tends to go their way. But the housing market and all of its esoteric calculations has been, one of the areas that's really been stubborn. And I think that, even Fed officials would acknowledge that. But again, this is a fairly dovish institution. But to give the Federal Reserve credit, they said that they could have a trade-off of bringing down inflation without a material impact in the labor market. Now, to counter, they got a really good luck in terms of the immigration surge, but tracking to date. So again, I'm not cheering against the soft landing. I'm just waiting to see, where does that calculus, given their aggressive cuts and what likely will continue for a little bit of time, where are we 6 months from now? And that's something that we will continue to focus on.
Joe, before we let you go, how much are you expecting the jobs report to surprise the upside or the downside when we get them on Friday?
Oh, my goodness. I've been employed for 22 years, in part because I've tried to avoid these questions. But I would say there's modest risk on the downside, but take that with a grain of salt. If I was that accurate, I would probably already be retired.
I love it. I expected you to be like, whoa, suddenly disturbance, can't hear you. Joe Davis of Vanguard, thank you so much for being with us. We really appreciate it. Tony Rodriguez, head of fixed income strategy at Nuveen. And what do you make of that? What we just were hearing about from Joe, that essentially the bond market's taking its cues from the potential weakening of the labor market, whereas stocks really are looking much more at GDP and GDI.
I think that's accurate. And I think when you take that to the fixed income context, you're seeing the equity-like response in the credit markets, right? So emerging markets are doing well, preferreds are doing well, high yields doing well. So credit risk is highly valued right now, and the fundamentals are very solid. Defaults are low, corporate profits are good. So you're seeing the same story in the fixed income market. It's just that it's focused on the credit sectors. So I think the disconnect is maybe that in the treasury market, you are seeing people that are kind of hedging against their risk book. So if you have an aggressive equity position, one of the only things that's going to work well, if in fact we get the hard landing, that's not the highest probability, Treasuries will rally, Treasuries will serve as a hedge. So I think there's a lot of money in that market that is serving as a hedge to taking risk in the credit markets, taking risk in the equity markets, private markets.
That didn't work, though, over the past couple of years, because the risk was inflation, and the different kinds of risk can mean that the bonds can be a buffer or not. Are you basically saying that increasingly bonds are a diversifier because inflation is off the table, that is no longer a concern in any investor's mind that you speak with?
Essentially, yes. I mean, we wouldn't say inflation risk is off the table completely, but it's certainly much lower risk than it had been. We do think inflation continues to come down. So when you think of fixed income, you want to get income out of it, liquidity, and a hedge and stability. Back when inflation really started to take off in 22, there was no income in it. There was no potential for protection because rates were so low. There was still liquidity. We sit here today and you have income now out of your fixed income portfolio. Treasury is probably the least attractive area to find it, but you do have income in it. And you do have now what we think will be a hedge because you're coming off of 3.5% to 4% type of levels rather than what had been sub 2% levels.
So, Tony, yesterday, we have a big risk-off type day. It's pretty textbook over geopolitical fears in Iran and Israel. It's pretty textbook except for credit markets. Spreads barely move, maybe 1 basis point for the overall market, maybe 5 for high yield. Is it a market immune to geopolitical risk, or is it just more calm investors? What is it?
Yeah, I don't think it's immune, but I do think it's more calm investors. Even oil prices, while they went up, they didn't spike as much as you might have expected. So I think people, maybe it's the frog in the boiling water type of syndrome, that all of these geopolitical risks, there are so many hotspots out there, and there has been escalating risk in all of them, that maybe the markets have seen the movie before, and it's going to be, a really cataclysmic event if in fact it gets to the point where we start to see really the Mideast theater expand into more players. But for now, I think the market's looking at it as this has just been the ebb and flow of this, continuing escalation that we're seeing. So we haven't had a major disruption, but it's a big risk out there in our minds, is that geopolitical risk.
Yeah, so if you were going to take that risk on board and you were actually really nervous that this was a different movie than the one we've seen, what should you be doing?
Well, from our perspective, there's a couple of things. One is that you don't want to be at the high end of your risk budget. When you look at not only the risks that are out there, but when you also look at just valuations in the broader capital markets, right? Fixed income, you look at credit spreads, equity market, you look at valuations. None of them are considered, historically cheap. They're at best case fair, maybe aggressively priced. So that tells you want to have some powder dry. You want to be kind of at the midpoint of your risk budget. In addition to that, within all the various asset classes, we're leaning more towards a little bit higher in quality, a little bit higher in liquidity, and making sure we have stronger fundamentals that can kind of see their way through any potential, impact from economic weakness coming from a geopolitical event.
There's sort of this counterintuitive feeling right now in markets. There's a real question. We were talking with Wei Li of BlackRock earlier this morning, who agrees with her colleague Larry Fink, who was talking about that maybe this bond market has priced in too many rate cuts. At the same time, that people are talking about the potential for downside surprise that inevitably the Fed would respond to. Do you think that there has been sort of an overstating of the Fed's reaction function? In other words, a more bullish position on the economy? Or do you think that people are going to be surprised by how much they are going to have to cut?
No, I think that the markets are pricing in too many cuts. So there's been an overstatement of that. I do think that the probability of soft landing increased quite a bit when the Fed cut 50 as their initial cut rather than 25. And also when you saw what China has done over the last week and change, where again, they're not game-changing things out of China, but they are stabilization and first step moves by China. All of that helps to reduce the risk of hard landing. So to us, the Treasury market, the Fed funds futures market, aggressively pricing. Part of that, though, is because there are flows in those markets that are hedging. They're using that market to hedge. And we do think that if you get a hard landing, a very significant geopolitical escalation, the Fed's not going to stop cutting at 3.25 to 3.5, which is what our target is for the middle of next year. You'll see a sub 2% funds rate. You'll see a 10-year that's at 2% or lower. Again, that's a very low probability in our minds, but it will be an effective hedge to the declines you'll find in your equity market or the widening in spreads you might see in the credit market.
So if that's the low probability, does that mean base case, just the natural place for yields to go from here on out is higher?
I think base case is range bound. I mean, we kind of think fair value, 10-year, 3.75 to 4% is about fair value. It's a real rate that might end up in that 1.5 to 2% area. And we think that's a good long-run equilibrium level. You rarely get to that level and sit at that level. But for now, that would be what we think is the fair value zone. So it's just the Fed that needs to get down in terms of the funds rate. Patiently in our minds, not 50 basis point cuts, but 25 basis point cuts. And if that happens, you can get this, sought after soft landing, which can help the U.S. economy grow. We don't think at 3%, but maybe sustain a 2%, 1.5 to 2% type of pace.
What's your call on the payrolls on Friday?
We'd say that the risks are probably to the downside, but not materially. So 100 to 150 we think is the right range.
Tony Rodriguez of Nuveen, thank you so much for being with us.
This was the deal. We agreed to it. If the stock closed at an all-time high on Investor Day, Marc Rowan would show up alongside me, and he's a man of his word. Marc, good morning. It's good to see you.
Thank you. And technically, you're here. You came to visit us, so thank you.
Thank you. You planned it this way, I'm sure. Big target for 2029, $10 billion of annual earnings. I think we have to start with a pretty broad question. Rates are coming down. Economy's pretty decent. Let's just call financial conditions easy. Why are people coming to you instead of just issuing a bond in public markets?
I think if they come to us when they can't issue a bond in public markets. And can't is not that it's not open. It's that they want to do something that the public markets will not allow. Public markets over the past 2 decades have become very vanilla. Call it beta. If you want to do something unique, if you want to finance the next generation of infrastructure, you want to build a project, you want to build data centers, you want to build power, you want long dated, you want special features, that's just not available. You come to someone like us, and increasingly, private markets are offering really compelling solutions to investment-grade borrowers.
Let's talk about some of those deals. AT&T, AB InBev, Intel recently. What's the common theme behind those 3 companies for you?
The common theme for us is excess return relative to the credit of the underlying borrower. The common theme for the issuer is they are achieving something they could not otherwise achieve. When we did AB InBev, some $6 billion years ago, everyone around us, our peer group, That was interesting. That was one-off in COVID. You'll never do another one, another investment-grade private deal. $100 billion later, we're still doing investment-grade private deals. And I see nothing but a long line of interesting borrowers and interesting situations, because think about what we're doing in the world today. We are building infrastructure. We are building and changing energy transition. We're just at the beginning of this, and we are building the next generation of data and power. Every one of those things is long dated. Many of them are complex financings. Some will go to the banking system. Some will go to public markets. But increasingly, for these more complicated financings and long dated financings, private market investment grade is where borrowers are coming.
There was a theme in Investor Day, and you've talked about this with me yourself privately. Global industrial renaissance. What are you talking about?
We're talking about just this massive need for capital. I mean, you can believe or not believe all the figures that are out there, but when you add up the amount of money that is needed for energy transition, the amount of money that is needed to fix our infrastructure, the amount of money that will be needed to build data centers and power to supply them, much less to connect and redo our power lines, you're talking about the amount of money that's been spent since the invention of fire. All with a backdrop of the U.S. government borrowing $2 trillion to finance itself on a current basis. This is not a question of will private markets grow. The question will be how much. Yes, public markets will continue to play a really important role, banking system, really important role, but this tool, this notion of private investment grade, has really not been available to CFOs or others arranging financing, and increasingly it will be.
How labor intensive is this for you? And as you do more deals, do you get a benefit from that you are able to replicate things and use less and less people to scale up?
The scars of experience. Yeah. So these are all labor intensive, and that is actually what the competitive advantage is. The investment grade bond market became so efficient and so low cost that financial firms stopped allocating resources to it. There was just not any money in doing that. And so the market is very available, but it is very plain vanilla. Almost no one has built what we've built. When you look at employment at Apollo, the greatest group of employment, 4,000 people, some $8 billion that we've spent over the past 15 years, all goes to what we call origination. Now, not all of these originators are out calling on investment-grade borrowers. Some are running other types of origination vehicles: aircraft finance, fleet finance, receivables finance, inventory finance, infrastructure finance. Increasingly, this is how America borrows.
Introduce Citi and a $25 billion partnership. What's behind that? Is that an acknowledgement from you that you've got more cash than you know what to do with?
I think it's an acknowledgement that origination, the control of the product, is actually what has value. And some of that origination we're going to build ourselves, and we've built more of it than any. But let's face it, a whole industry is short origination. To the extent we can find a meeting of the minds with Citi, that's fabulous. And I think the bigger theme here is the banking system, particularly one of the big four banks, is actually figuring out what we believe all along. We don't want what the bank wants. We don't want the bank's customer. We want the asset. The bank, we can't offer advice, M&A, derivatives, hedging, foreign exchange, payments, credit cards, or any other service. The bank wants to offer those things. The bank sometimes wants the loan, but more often than not does not want the loan.
Who do you think fielded the most calls that day when that was announced, that partnership? Was it Jane Fraser and annoyed asset managers, or was it you and annoyed bankers?
From the comparing of notes last night, it was Jane.
It was Jane? Did you get the calls yourself from other banks?
We definitely got a few calls.
Do you get the sense that this is the beginning of something bigger? 25 billion is the number with Citi. Just give me an idea of what this looks like further down the line. Does it include other banks too?
I think it does. And now, I think it is difficult to serve lots of people in the same way with the same terms, but the Citi partnership is focused on a certain type of borrower. I think you'll see international partnerships. I think you'll see investment-grade partnerships. I think you'll see infrastructure-related partnerships. I do think that we are becoming a partner in some ways to the banking system, rather than how it is portrayed in the press, which is, a fierce competition over everything.
This conversation so far has really been about how the financing of companies, particularly in this country, is changing, how the companies doing the financing is shifting, the emphasis being on private markets. Part of your vision is how investing is going to change as well. So let's spend some time on that. How is investing going to change? How do we think about public versus private now? And how do you hope we're going to think about it in years to come?
Look, for me, this is year 40. It's sometimes hard to believe I've been doing it this long, but we grew up thinking private was risky and public was safe. And probably 40 years ago, that was true. Private was 3 products: private equity, venture capital, and hedge funds, all 3 of which can be risky, but done the right way are excellent investments. And public was 8,000 public companies, diversified portfolios of stocks and bonds. Let's just say that's not how the world is today. The world that we see, private is safe and risky, and public is safe and risky. And if that's true, everything we know about portfolio management, the way we construct portfolios today, is going to change. Think of the typical investor. A very bland, I say a 3-flavor ice cream portfolio.
Sure.
Stocks, bonds, and a little bit of alternatives. Why? Well, because when something is risky, you put it in a small bucket called alternatives. You watch it carefully, and you demand high returns out of it. But if private is just another form, I think what you're going to see is the whole business of what I call replacement. Fixed income, which today means investment-grade public credit, I think is going to be investment-grade public and investment-grade private. 18 months from now, I do not believe investors will actually know the difference between investment-grade public and investment-grade private. It will not be the issuers. It will not be the size. It will not be the ratings. It will not even be the liquidity. Everything that exists in the public markets, repo, borrowing, market making, daily pricing, is coming to the private markets.
What is the total addressable market? What kind of numbers are we thinking about?
We're talking about massive marketplace. When we look at the entirety of our industry, has been built out of the alternative bucket of institutional investors. The fixed income bucket, which is the one I'm talking about now, is 50% larger than the alternative bucket and is mostly 100% public investment grade.
Equity, different to debt. Can you tell me how that's going to be transformed and whether some of the companies that typically would be going public are going to stay private, whether we're going to see a big shift in capital markets over the next 5 years or so on that front?
Well, we're seeing it already. So this is a two-pronged answer, which is 8,000 public companies is now 4,000 public companies. Fewer than 100 companies go public every year and more than 100 companies go private. There do not seem to be compelling reasons for companies to be public, particularly with what's happened on the investing side. So much of our market today is indexed and correlated. Think of passive now 60-70% of the overall marketplace. Active management, which historically has been the buying and selling of stocks, has really been a very, very difficult place to be, has failed to beat the index 90+% of the time for 20 years. I think we're going to see an evolution also take place in equity. It's going to happen more slowly. In fixed income, we are going to see fixed income replacement. Public and private essentially come together. And the reason I know that is we're seeing it every single day. And in fixed income, we have arbiters of credit quality, rating agencies, who tell investors that something public and something private is of the same quality. In equity, we lack those arbiters. But nonetheless, I think investors are beginning to understand when 10 stocks are 35 to 40% of your portfolio and 4 stocks have determined all your returns for the past 4 years and 1 stock has basically been 100% of your quarter. I mean, think of what we've done as a country. We've taken the largest pool of savings in the world, 401k, $12 to $13 trillion, from a group of people who need retirement savings more than ever. What do they own? They own daily liquid stock index funds, generally S&P, for 50 years. Why? Well, we have a mistaken belief that public is safe and private is risky. You look at the best retirement system anywhere in the Western world, in Australia, where they've introduced superannuation 40 years ago. Just a fancy way of saying is they gave the equivalent of 401k investors access to private markets. The returns have been nothing short of spectacular. Outcomes for investors can be not a little better, 50 and 60% better.
You know the view here, public is transparent and private is opaque. How do you change that view?
Well, I think it's going to happen in fixed income. I think when you get to daily pricing, when you get to daily liquidity, when you can see a market, but let's not fool ourselves. Markets are different than we think they are. Everything changed in 2008. As it should, as a response to the financial crisis. But we just did not experience as investors those changes because right after we changed the rules, we printed $8 trillion and everything went up and to the right. One of the most interesting things that changed, there is no liquidity in public fixed income. The stats I've seen, it takes 5 days to sell an investment-grade corporate bond. So when you see a quote, is that liquid? Well, we feel good because it's public, it's there, we can see it. I do think we're going to end up not caring in fixed income in the next 18 months as to whether something is public or private. The comfort that people are developing in private markets on the fixed income side, I believe will eventually extend to equity, and we will see equity also adopt private side by side with public. As I sometimes joke, investors will own equity that is private rather than private equity. The difference being the leverage.
You say we, you mean investors. Do regulators see it the same way?
I think they do. I mean, the conversation with regulators is actually a fascinating one because clearly change is scary. But the typical conversation is every dollar of borrowing that moves outside of the banking system to the investment marketplace. And let's face it, there are only two choices for regulators. Money in an economy can come from investors or from banks. There's no third choice. So every dollar that moves actually delevers the banking system and makes it safer. And people recoil in shock, and this is just math. A bank is levered 12 to 14 times. The typical institutional investor is levered 0. The typical mutual fund, levered 0. Typical BDC, levered 1.5 times. Typical retirement services company, levered 8 times. It is deleveraging. The second is disclosure. We think it's not transparent. The typical bank disclosure says loans to customers and loans to companies. You click on our website, you can see every security we own every quarter. Then you talk about maturity transformation. Maturity transformation is really where the economy has suffered and financial markets have suffered. Banks are in business to do maturity transformation. They borrow short in the form of deposits and lend long in the form of loans. That's not a bad thing. That's just how they're set up. In the investment marketplace, generally you're talking about investors who are matched from a maturity point of view. And the final thing that I always sit with regulators, what percentage of assets in the U.S. banking system are investment grade? They don't know. We have a perception that they're all investment grade, but the reality is about 60% of bank assets are investment grade. You look at a balance sheet like ours, and just as an example, we're 90+% investment grade. And so it's change, but it is actually change that is making the system more robust and more diversified. And we, let's make no mistake, we are the envy of the world. We, the U.S., are the envy of the world. In Europe, they are squeezing the banking system through Basel Endgame, but they haven't yet decided to allow investors to fill that gap. And there are questions. Why are we struggling with financial markets? Well, you're squeezing the banking system and you're not allowing investors to fill the gap.
Have you had this conversation with the senator from Massachusetts? Has that conversation ever happened?
It hasn't, but I welcome it. I spend lots of time in D.C. and elsewhere speaking to regulators because we are in a really dynamic phase. Everything that we think works the way it works has changed. And we're about to experience and are experiencing the changes that were made in 2008 in response to the financial crisis.
Speaking of changes, Washington, D.C. is becoming increasingly interventionist. You compared some of the benefits of doing business in America and doing business in Europe. Doing business in America is arguably not as easy as it used to be, and it may well get harder. What's your view on where we're heading?
You may be right, but it's all relative. This is the single best market to be in at this point in time, bar none.
When we spoke before Christmas, and we talked about the choices on the menu then for the upcoming election, you weren't too impressed. The menu's changed a little bit. What's your view?
Since I'll be under banishment here if I give you a direct view, let me just say, the way I frame this is you are either more scared of 4 years of the status quo or more scared of 4 years of change. You just have to decide what you're more scared of. Me personally, I'm more scared of 4 years of the status quo.
What's wrong with the status quo?
I see a direction where the trend is not our friend. Right now, we are, as you suggest, we are the single best place to do business in the world. We are the luckiest people in the world. Can we screw it up? Yeah, we can. The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
Do you see anyone on the campaign trail that's willing to do anything about that?
On the campaign trail, no.
In reality?
Let's hope. All we can hope for is better governance.
I've said repeatedly on Bloomberg surveillance, on Bloomberg TV, on Bloomberg radio for years that America has the privilege, the unique privilege of acting recklessly. Are we losing that?
Not yet. We have a long way to go. We have lots of examples around the globe of people who have acted recklessly for a much longer period of time than we have been acting recklessly. But we also have obligations that others do not. Right now, we are the beneficiary of being the strongest economy, the strongest capital market, the strongest military, and the best place to do business. I mean, if you tick off what's happened over the past years here, we may not like how we got here and how we financed it. 3 years ago, we decided to build infrastructure. We allocated $2 trillion. None of that's built yet. It's all being built. 2 years ago, we spent $52 billion of semiconductor subsidies to build semiconductors here. Not a single plant is open. It's all being built. A year ago, Inflation Reduction Act to encourage the manufacture of renewables. 1.3 to 2.3 trillion. No one really knows. Not a single plant is opened. We are the beneficiary and the largest recipient of foreign direct investment 3 years in a row. So people around the globe are actually figuring out we're better off here. And something tells me we're ramping defense production. All of those things are fiscally stimulative and positive for employment. Oh, by the way, we have no illegal immigration. This sets us up very well fiscally for a strong economy, which I think we're seeing.
Federal Reserve is cutting interest rates by 50 basis points. Are you in Torsten's slot camp? And you can agree or disagree with Torsten, of course. Torsten works here. He believes this economy doesn't need rate cuts. We're in a great place. Do you share that view?
I said it right. I was, I guess, unfortunate to be on TV an hour after the rate cut. And I said this was a very, very expensive insurance policy.
What's expensive about it?
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet we're stimulating. And we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time. And to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter, to the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now. So am I in the Torsten camp? I'm absolutely in the Torsten camp, and it's my privilege to have him down the hall. I make sure to check in with him every morning.
I do as well. Marc Rowan, this was a privilege, a pleasure. Good luck for the next 5 years, and I hope to talk to you every year.
Every year you get to do it. Thank you.
Marc, thank you, sir. Appreciate it.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.